So as a starting point, we just want to quickly reflect on that change from tax migration to, or from financial immigration to tax migration. There was a shift that has happened, and that legislation and process has changed. That change came about on the 1st of March, 2021. What's important there is to note that on the 1st of March, 2021, financial immigration was phased out and tax migration replaced it. The difference between those two fundamentally is that in financial immigration, the South African Reserve Bank was involved in the process, which meant that you would fill out that NP336B complicated form where you declared your assets and liabilities. That application would go through to the South African Reserve Bank. They would reply with an approval, giving you an ECA letter, and then you were effectively seen as a non-resident. That has fallen away. The entire process is now done through SARS. So there's no more MP336B form. The entire application is done with SARS, and effectively you are ceasing to be a tax resident. The other fundamental change that happened with the movement from financial immigration to tax migration is the withdrawal of retirement annuities. What we've seen in the past is a lot of individuals who are living abroad do financial immigration because they wanted to withdraw their retirement annuities. Sometimes living in a first world country is a lot more expensive than what you anticipate. The rule has been changed with tax migration in that you must be a non-resident taxpayer for 3 consecutive years before you can withdraw those retirement annuities. But we're going to go in a bit more detail on that later on. The other big change here is that when you did financial immigration, they opened what they called a blocked RAND account. And that blocked RAND account meant that you had to close all your other bank accounts in South Africa upon doing that application and only use that blocked RAND account. That blocked RAND account also meant that you could only transfer funds in and out of the country through that particular account and with that authorized dealer who had handled your financial immigration. That no longer happens. So now you don't have to close your bank accounts. You merely, once you've completed tax migration, you change your status of your account to a non-resident status. Okay, that's very important. And it's quite a big shift. And the great thing about this is it gives clients who have done tax migration a lot more flexibility around who they would use. Okay. Obviously, the single discretionary allowance falls away. That's important. And you now require a TCS PIN in respect to immigration. That TCS PIN, we now have a requirement for an AIT, which is a new regulation came out on the 24th of May this year. And that's an approval of international transfers. This change was to merge our foreign tax clearance application for the foreign capital allowance, that tax clearance application, with this tax migration tax clearance application. So that's the reason for the change. And this AIT allows you to then externalize funds, and we'll go into that detail a little bit later too. Okay, so let's talk around why tax migration is so important. A little bit of detail on that. I'm going to hand over to Mariska here. Mariska, can you just give us a few points around the importance of this new legislation and what that means for clients?
Yes, Lauren. So it's important because it's actually an obligation in terms of the Tax Administration Act to inform SARS if any of your registered particulars have changed. And that would include your physical address, if your bank has changed, and also very important if you have ceased tax residency. Then also, immigrating from South Africa doesn't automatically make someone a non-resident. This is something that we get a lot, is people do think that they leave and then they are an immigrant, but that really only means that they are a South African tax resident living temporarily abroad. And why this is important to inform SARS is because in South Africa, we as South African tax residents pay tax on our worldwide earnings, and we pay tax on, or capital gains tax on, our worldwide assets. But non-resident taxpayers would only pay tax on their South African source-based income. So it's very important to actually take this step and to inform SARS, because then you completely don't need to inform them of your foreign earnings. Then on step 6, and the reason why this is so important is because there's a big misconception that happens where a lot of people think that if I earn below 1.25 million Rand, then I don't need to inform SARS. But so all of us know, obviously, in March 2020, SARS put a ceiling on that foreign earnings, where before that used to be fully exempt. And if you met the requirements, you didn't need to pay tax here. But that changed in March 2020, where now only the first 1.25 million rand is exempt, and then the excess will be taxable in South Africa. The further relief is that there is a foreign tax credit. So if you would pay tax in your foreign country on that income, then obviously there's a credit available to you in South Africa. And because of those two reliefs that you receive, a lot of people think that if I've emigrated and I earn below the 1.25 million rand, or maybe I have the tax credit, then I don't need to inform SARS of this. But the truth is really that if you live in another country and the tax treaty rules, which we'll discuss a bit later, but if that tax treaty rules make you a resident of that country, then this rule doesn't apply to you. It's actually one of the requirements that it's only available to South African tax residents. And mainly the reason is, Lauren, that non-residents don't pay tax in South Africa on their foreign earnings. So there's really no need to apply this exemption. And then also another requirement is that you need to be in an employment contract, so no subcontractors, no independent contractors, and also you need to spend at least 183 days, of which 60 need to be consecutive outside of South Africa. So I just want to summarize that a bit to explain when it will be used. This is if someone maybe lives in South Africa, they have a home here, their family is here, but they maybe go on contract work or maybe go work offshore, then this is really what this exemption is for. But if you've packed up and left and you live in another country, then this exemption is not available to them. So it's just such a big misconception that a lot of people think that either I need to do financial immigration, which they all refer to it as still, or I can just use my 1.25 million rand, but it's really not available to them. So the relief that is available to them is in terms of the double tax agreement, which will allow taxing rights or exclusive taxing rights to one jurisdiction. And we determine that by looking at the tax treaty to see who will have the right to tax that person.
Okay, that makes a lot of sense. So let's talk around the ceasing tax residency, because I think there's a lot of confusion around this. We know that there's tests that we apply in terms of when you are breaking your tax residency. Can you take us through those tests and just explain a little bit more detail how that is applied and how it works?
Yes. Okay, so we have two tests, and I'm first going to explain the tax treaty rules, because this one can trigger you ceasing tax residency whether you want to or not. So a tax treaty is basically that South Africa has entered into double tax agreements with most other countries, and that just means that one of the countries will have the right to tax you. Now, each country has their own unique rules of how you would become a tax resident, and we can explain a few examples just now of how that works. And then if you are triggered by that tax treaty, then the date of ceasing tax residency would be whenever you've met the requirement, and that will make a little bit more sense just now with examples. Okay. Then the second test that we look at is the ordinarily residence test, and this is not defined in the Income Tax Act, but basically what it means is just what is your intention for the future? Where do you intend to return to after you're wandering? So do you plan to just maybe go work in the UK for 5 years, but then actually you're going to come back to South Africa? In that case, you won't break ordinarily residence. It's only if you have packed up everything, you have no intention of coming back, then you would break ordinarily residence, and your date of ceasing tax residency would then be the date that you've actually left South Africa. Breaking tax residency on this test is quite important, because if you do break ordinarily residence, then in the future, when it comes to your estate duty, then your worldwide assets would be excluded from South Africa. It would only be if you have South African assets remaining. So it's very important to break tax residency in that way if you never have intentions of coming back to South Africa. So ordinarily residence is on your intention, whereas tax treaty is on whatever the rules of that country is.
Okay, great. Well, let's look at some examples, because I think it can be a little bit confusing. So the examples we're going to look at now is really around specific countries where those double taxation agreements are in place. So I think as a starting point, Mariska, can you take us through the first example?
Yes, so we can look at the United Kingdom, and for their tax year runs from the 6th of April until the 5th of April the next year. And if you spend at least 183 days of that period in the UK, then you're a tax resident of the UK. So it could be that easy to become a tax resident. And it could be that maybe you only have a contract to go there for 2 years. And then you intend to come back to South Africa. So your intention is to come back. You don't break ordinarily residence, but because you have been in the UK for 183 days of 2 of their tax years, you are a tax resident of the UK for those 2 years. So the tax treaty is always something that we look at on a year-to-year basis. And it could be that you're a resident 1 year and the next year not, and vice versa. So
okay.
yeah, so that's
Can
for
I
the UK.
just on that point? I think because there's so many South Africans that are in the UK, as an example, and we see the shift coming with the AITs now with tax clearances. I mean, if we look at that AIT application process and the fact that the first question that's been added there is your residency status in terms of SARS, how does that impact this? When you are still a South African taxpayer and you're applying for your foreign capital allowance tax clearance or AIT, how does this impact that if you've been in the UK for 2 years?
For 2 years. Well, then you'll have to answer that you are a non-resident, and then it becomes so much more complicated because one of the requirements then to attach to that application is your notice of non-resident status change, which is something that you get after you've ceased tax residency. So it does become complicated, and I almost feel like this is a way to also have people do their tax residency status change, because you can't say on this form that you're a resident when really you are not.
Yeah, okay, interesting. Okay, let's look at another example that's quite common. If we look at the UAE, how does that get applied?
Yeah. So for the UAE, if you have a valid Emirates ID and a valid residency visa, then you're a tax resident of the UAE. And you can't go to the UAE without having either of these. So it's almost immediately when you move there, then you're a tax resident of the UAE. And especially for the UAE, it's very beneficial for you to seize your tax residency because they have no individual tax rates. And it's very easy to earn above 1.25 million rand. So you wouldn't want to be earning a high value there and then needing to pay up to 45% tax in South Africa. So especially for people in the UAE, this is important for them to do.
Okay. Let's look a little bit more into that double taxation agreement. Can you just give us a few more details around it and how it's applied?
Yeah. Okay. So the double tax agreement has a tiebreaker clause. And the reason why they have this is because now we are a tax resident in 2 countries, because you're a tax resident in South Africa, because this is where you've been working and you were born here, so you're a tax resident. But now you go to the UK and you also become a tax resident in the UK, and you can only ever be a tax resident in 1 country. And that's why we have the tiebreaker clause in the double tax agreement. And there's 5 things that we look at, and they are looked at in this specific order. And if you meet 1, then we don't need to look at the rest. So you're now a tax resident of both countries, of South Africa and the UK. So then we ask the question, where do you have a permanent home available to you? Now, if you live in the UK, obviously you do have a permanent home available there. You don't have to own it. You can also just rent it. So you've got your permanent home there. Then we look at South Africa. If you've got a home available to you where you can physically get on a plane, fly to South Africa and walk into that house, then that means you've got a home available to you, and you'll also have a permanent home here in South Africa. If you still have property in South Africa, because lots of non-residents leave their property in South Africa, they rent it out, maybe full-time, or it's on Airbnb, or maybe it's just a rental property, then that's not available to you. So you don't have a permanent home available then. Then that would mean you're a tax resident exclusively of the UK, and you'll inform SARS of that fact. But let's say now you do have a home that you're leaving in South Africa because for any reason, there's no one living there. Then we will look at the next one, which is your center of vital interest. And this just means where's your personal and economic ties closer. So did your wife and kids immigrate with you? Do you have employment in that country? Are your kids going to school there? Where's your bank accounts and your investments? And just basically, where did you set your life up? And if that's closer in the other country, then we take you out of South Africa's tax nets and you're a resident in the other country only. But if it can't be determined because your economic ties are just in both countries equal, then we will look at where's your habitual abode. And this just means where do you rest and recoup the most? And if it can't be determined on that, then we will look at where are you a national. And if you're a national in both countries or neither of those countries, then the competent authorities of those two countries would need to decide who has the right to make you their exclusive tax resident.
Sure. That's a lot of questions. Okay. Do you ever get to that point where you get all the way down to the last question?
No, mostly people fall out at the permanent home because most non-res or people who leave would sell their properties, and then we would also get them out at the center of vital interest. So no, we hardly ever get to that one.
Okay, so let's talk about the consequences of tax migration and ceasing tax residency. And consequences sound so negative, but I know we get a lot of questions around, what happens? What am I get taxed when I do this? What is the CGT implication when I do this? And people are terrified of that. So let's talk through how that works. Mariska, can you explain to us how that exit tax process works and what is included?
Yes. Yeah, so the exit tax is basically just capital gains tax that you're going to pay on your worldwide assets. And it's a deemed sale of your worldwide assets on the day before you cease tax residency. So you can look at it in this way, that the resident you are selling your assets to the non-resident you. So you don't physically have to sell your assets, it's just deemed. So there's a few assets that will be excluded from this deemed sale, and that is if you have fixed property in South Africa. And the reason for that is just because residents and non-residents pay the same capital gains tax on fixed property. So if you sell your fixed property in the future, then the non-resident will pay the capital gains tax. And for that reason, no deemed sale on that one. Then also, if you've got interest in a discretionary trust with no vesting rights, that just means that you actually don't own anything from the trust. So there's no capital gains tax that will deem there. And then also retirement annuities, because they have their own tax rates.
Okay.
But all other assets that you own, like if you have investments in private or listed companies, or maybe you've got foreign property, then all of those would attract capital gains tax. And the proceeds in that transaction would be the market value of the assets the day before you cease tax residency.
Okay.
There's just a very important thing that's very important to note is when you are a beneficiary of a trust and you are going to receive future distributions from this trust, then it's so important to do proper tax planning around this, because the reason why people form trust is to safeguard their assets, obviously, and also for tax planning purposes. And in a trust, we use the flow-through principle, where the trust would hold the assets and then the beneficiaries. Let's say this trust has property and they've got 4 beneficiaries. Then the trust can sell the property. And if the trust needs to declare the sale of the properties in the trust capacity, it's going to pay capital gains tax at 36%. But now we use the flow-through principle, where we say, okay, the trust sold the properties and we're going to distribute that to the 4 beneficiaries. Then the beneficiaries will pay the capital gains tax at 18%, because it retains its source when it's distributed to the individuals. So that's a big tax saving. But now the Act allows for an anti-avoidance rule that if a distribution is made to a non-resident, then the resident will be paying the tax. So in that case, if one of these beneficiaries is a non-resident, then the trust will end up paying that at 36%. So it's just very important that before emigrating or making this big decision, just to do tax planning in your trust to see, is there anything that can be distributed beforehand, or what planning can be done around, just to save a lot of tax in the future.
Yeah, that's a very good point. We see a lot of those distributions happening. And I think we're not really necessarily aware of that difference and how big that difference is in the tax until it gets to the point of the distribution, unfortunately.
Yeah.
Okay. Let's go to retirement annuity withdrawals. So it's been a big mind shift, I think, for a lot of people with the legislation changing from financial immigration to tax migration. In our experience, as I mentioned earlier, we see the rule in our mind as a good thing because effectively it's forcing South Africans to just wait that 3-year period before they withdraw their retirement annuities when moving abroad, as opposed to withdrawing it and spending it because they need it. And then a lot of them end up coming back, unfortunately, and then they're starting from scratch in terms of the retirement planning. So we're going to go through just quickly how that works. So what are the rules around it and what has changed? So we know, as I said previously, you could do financial immigration before 1st of March 2021 and then do your application, withdraw your retirement annuities instantly. With the new legislation under tax migration that is managed by SARS, you have to wait 3 consecutive years of being a non-resident taxpayer before you can withdraw those retirement annuities. What is important there is that you can backdate that, and we'll explain that in a bit more detail. So the difference in the tax rate, remember, is applied if a retirement annuity, so there's a difference because it's not being withdrawn usually at maturity. So, but Mariska's going to take us through the details of what is applied and how it works. So Mariska, I'll hand over to you quickly on this.
Okay. So if you withdraw at maturity the age 55, then there is a tax benefit. You do pay a lower tax rate. So the first 550,000 is tax free. This used to be 500,000, but in the budget speech this year they increased it by 10%. So then the balance is taxed at 18 to 36%. And you can take a full lump sum, but only if the value is below 247,500 Rand. If it's above this, then you can only take 1/3 lump sum of your retirement annuities, and the remaining 2 needs to go into a living annuity in South Africa. So that means that you're still going to be subject to normal tax in South Africa. You need to submit your tax returns in South Africa. So that then continues as normal. But now you live in another country, you're a resident of the UK, and most of the double tax agreements allows for taxing of pensions and annuities in the country of residence. So that means now the fund in South Africa is going to deduct the tax on your living annuity, but then you also need to declare it, for example, in the UK. So there's double tax that arises here. Obviously, the double tax agreement allows that one of these countries need to give you a relief, and that would have to be South Africa. So there's a lot of admin involved if you decide to, as an immigrant, withdraw your annuity on maturity and then, retirement on annuity and then retirement and then have the annuity left in South Africa. So the admin around it is your tax returns that need to be submitted. And then you can apply for a tax directive from SARS, because now obviously you need to pay this tax in our example, the UK. So if you can prove to SARS that you've paid the tax in the UK, they'll allow a tax directive, which would then allow the funds in South Africa to deduct a 0% in South Africa. And this tax directive is then valid for 3 years. The problem is that it's just in the first year of earning this annuity where someone will then end up paying double taxation, because you'll receive your annuity net of tax, and then you need to declare that full amount in the UK and pay tax on it. And only once you can prove you've paid the tax, then SARS would give you the tax directive. Obviously, you can claim a refund for that tax, but the first year is going to end up in double taxation. And then after that, every 3 years, you'll apply for the tax directive. So just important to note here that there's going to be a bit of an admin burden, but they will pay a lower tax. And I think this option is only really applicable to people who are close to maturity age, if you consider everything that's involved in that one. Then if you withdraw at emigration, then only the first 27,500 Rand is tax-free, and then the balance is taxed between 18 to 36%. So there is quite a big difference in tax that's being payable. But the benefit is that they may withdraw the full lump sum, and that's the final tax that's payable in South Africa. So it does cut their ties with South Africa in terms of their annuities.
Yeah.
So it's also important that when they withdraw their annuities on immigration, that it needs to be paid into a non-resident bank account. So the whole cease to be resident process and tax migration process would need to be followed.
Yeah. And we obviously, we run this process. We'll go through the process a little bit later, but those non-resident bank accounts are open automatically when we run this process to be able to facilitate that. So when we are doing the withdrawal applications for these clients, that we can get those funds into the account quickly. Okay, and then let's just chat about expected changes. Mariska, do you want to give us a rundown on those?
Yes. Okay. So the current rules around retirement annuities is that when you have a pension fund, you can withdraw this immediately when you emigrate. Retirement annuities and provident funds is that you can withdraw this at the age of 55 or after 3 years. This is the rules that we just explained just now. And then pension and provident preservation funds, you can withdraw a lump sum once in your lifetime. But after you've done that and there's still a balance left, then that has the same rules as retirement annuities. So that's the current rules. Then there's proposed changes that they've implemented, and it will apply to all of these products, and all of these products would then basically be treated as the same. And the new rules the proposed rules would become into effect on the 1st of March 2024. And basically what they're doing is they're splitting it in 2 parts, but really it's 3 parts, because you'll have a value in all your annuity products on the 29th of Feb 2024. And what happens with the value in those products is that will go into your vested parts, and all the same rules as previously will apply to those values. Okay, so you have your vested part. Then from the 1st of March 2024, all your contributions and growth will then be split into 2 parts. And your 2 parts would then be, you'll have a savings part and you'll have a retirement annuity part. And it's almost the same as the rules are now, because your savings part would be 1/3 of your contributions and growth going into that part, and then your 2 other thirds going into your retirement part. Your savings part you can access once a year, so once every 12 months. It's not the tax year either. It could be if you withdraw this year in July, then next year, July, you can withdraw again. So once in every 12 months, you can withdraw from your savings part, and it's got to be a minimum of 2,000 Rand, and you can withdraw up to the maximum of that. But just very important now that this income that you get from your savings part is going to be added to your normal income, and you're going to be paying normal tax in that year on this withdrawal that you do. Your retirement part, so the 2/3 that go into that one, that can be accessed at retirement age 55, but that would then be used to purchase your living annuities. So just a few more rules that are in these parts is that in your vested part, so the value that you had on the 29th of Feb 2024, they will be allowing seed capital, and that would be 10% of the value of your fund, but it's only to the maximum of 25,000 Rand. And the reason why they have that is because this would go to your savings pot. So obviously on the 1st of March 2024, you wouldn't have had savings in your savings pot yet. So they're allowing you to take a portion of your value that you had at the 29th of Feb to take that to your savings pot just for your first year. Okay. Then if a member has been retrenched and they have no other income, then they will be able to access the funds in their vested pot. That's the pot at the value that you had at 29th of Feb 2024. And also they'll allow you to withdraw the full value in your savings pot if you have been retrenched and you have no other income. So I'm just going to summarize that because it is quite a lot to take in. But basically, on the 29th of Feb 2024, you're going to have a value in all your retirement savings, and that value will then go to your vested pot, which has all the old rules linked to it. And you can have seed capital of up to 10% to a maximum of 25,000 Rand, which you can transfer to your savings pot to be accessed in that year. And if you're retrenched and you have no other income, you can access those funds. Then going forward from the 1st of March, you'll have two pots, a savings pot and a retirement pot. And the savings pot is basically just to give you access to your savings throughout your lifetime if emergencies happen. So it's not really just to access because you want to. It's the reason for this is basically just for if emergencies happen. It is also very important that none of this will affect non-residents. The 3-year rule of if you are a non-resident and you've been out of the country for 3 years, you can still withdraw your full annuity, vested pot, savings pot, retirement pot. So let's say that someone emigrates next year, March 2024, then these rules will affect them for the first 3 years, but then after that, they can still withdraw everything. So they're not going to have anything stuck in South Africa. So it's just very important to note that fact as well.
Okay, yeah. Thank you, Mariska. Okay, let's talk through this process in terms of how this works. So if we have a client that has come to us that would like to complete tax migration, how do we apply that process? So on our side, usually the client comes to Currency Partners and we get that process running with a quick assessment. And once we've established exactly what that client requires in terms of tax migration, we do an introduction to Mariska's team to facilitate the SARS portion of that process. So let's talk quickly through that and how it works. Mariska, do you want to take us through that SARS process?
Yes. Okay. So the first step is to do a cease to be resident declaration to SARS. And this is your official method of informing SARS that you've broken tax residency. In the past, it was that you need to tick your tax return, but they've implemented this process. And there's a whole lot of supporting documents that need to go with this application to motivate why you are ceasing tax residency. And then if they accept it and it's approved, then they'll issue you with a notice of non-resident status letter. And this is basically like your golden ticket out of the tax net of South Africa. And it's a very important document. It's needed in so many processes in the future. And this step is necessary for everyone, anyone who either triggers a tax treaty or just intend never to come back to South Africa. They have to follow this step. Then next, what we will do, and step 2 is only if either someone has funds that they want to send out of the country as part of their immigration, or if they are eligible to withdraw their retirement annuity because they have been out of the country for 3 years. Then we'll apply for the approved international transfer. So basically the tax clearance where we say to SARS they have this funds and they want to send it out. And then once that's been approved, and you have been out of the country for 3 years, then we facilitate the entire process to withdraw the retirement annuity funds on behalf of them. So this would be facilitating with the fund house, applying for tax directives from SARS, and then having that paid out as well. And compulsory requirements of the retirement annuity withdrawals is that you had to have done the cease to be resident because you need to prove that letter, and also the AIT needs to be attached to that. Now, once all of these steps has been done, then you need to submit a final tax return, obviously to declare that you've withdrawn your RA, maybe you've had some South African taxes to pay in that year, maybe capital gains tax, so you'll submit your tax return, or actually we submit the tax return on their behalf. And then once that tax return has been assessed and they have no remaining income or assets left in South Africa, then we can deregister their tax numbers. And it's just so important if you've got nothing left in South Africa to deregister, because then you've got no more admin burden or SARS saying you've got an admin penalty because you didn't submit a tax return. So we'll then deregister. But there is obviously a lot of non-residents who have remaining income and assets in South Africa. So then they'll remain taxpayers of South Africa, but they are then non-resident taxpayers and not tax residents residents. So only their South African source-based income would be declared then in their annual tax returns. And that would be like if they've got property, so they've got rental income or interest or dividends or something like that. So the timeline here is that from step 1 to step 3, so that we're looking now at someone who's been out of the country already for 3 years and they are eligible to withdraw their retirement annuity. The process for them would take anything between 3 to 4 months to do the declaration, apply for the tax clearance, and get their retirement annuity withdrawal out and paid out. That's 3 to 4 months. Then we would have to always wait for tax season to open. So that can always sometimes be next year, or if they've withdrawn it early this year, it could still be this year. But then we'll have to wait for that tax season to open. And then once that return has been assessed, we can deregister. So that entire process can take up to 18 months. But it gets a little bit more complicated than that, because we could be working with someone who has just emigrated now in this year. Then all we can do for them is step 1. So after that process takes 21 working days. Once we have all the documents, we do the cease to be resident declaration. After 21 working days, they'll have their notice of letter, so their golden ticket letter out of South Africa, and then they are non-residents. So if they then in that process, if they have 3 years to wait before they can withdraw the retirement annuity, then it could be really that we're working with that taxpayer for 4 to 5 years actually, because they have to wait the 3 years. Then after that, they have to wait for tax season to open, and only then we can deregister their tax numbers. So it's very important for them to submit tax returns in those years of waiting for their retirement annuities to be withdrawn, because they need to be tax compliant by the time that they are withdrawing their RA. So for them, it's quite a long process that we walk with them, but yeah, it's all done within that period.
Yeah. I think it's also really important to reiterate that that document you receive from SARS to confirm that you are now a non-resident taxpayer, that you've ceased your tax residency in South Africa, clients must hang on to that. We have a lot of instances where clients don't have it and they can't find it. And it's so vitally important because you cannot do much without it. And there are different instances throughout the next few years or indefinitely where they will need it. And one of those things is moving money in and out of the country. So if they have still got assets here, etc., they need to hang on to that document. It is very important. And Mariska, how difficult would it be to get that document reissued?
So mostly we'll receive it, we'll have it on e-filing, so we can reprint it for them. But there's been so many times when people have had to redo it, because we are working with SARS. So it's just important to keep a record here, because we have had to redo it for some people. It's happened where people have actually done, and this is quite an important thing that we actually find a lot with people who remember before the 28th of Feb 2021, everyone was rushing to get their financial immigration through so that they can be, safe. But all of those people are needing to do the cease to be resident declaration now. If they haven't been deregistered yet, maybe they're receiving an inheritance now. All of them have to do this whole process now again.
Yeah. We're finding that a lot in the inheritance space, where those payments need to be moved. We can't do it unless they complete this process, and it can take quite a while to do it. So it's not great. Okay. Let's move on to some frequently asked questions, and maybe this will help explain some of the points we've discussed that maybe weren't that clear. So we're going to start with question number 1. So when I cease South African tax residency, do I lose my citizenship or permanent residency? No, you don't. So SARS and the Department of Home Affairs are not linked in this process. So your South African tax residency status, if you change it to be a non-resident taxpayer, it doesn't impact your status in terms of Home Affairs. So you retain your passport. Can I keep my South African bank accounts? And we've touched on this a lot throughout the slides. You can keep them, but you need to change that status to a non-resident status. There are implications around that. So it's just important to understand that we deal with a lot of non-resident clients, either because they've gone through tax migration or they are bona fide non-residents in South Africa. But effectively, when funds come in and out of those accounts, they are encumbered. So it's not an easy day-to-day transactional account. in that there are a little bit of rules around that, but effectively they can use it. There are possibilities to get cards and things linked to it, but the clearing of funds goes through a bit of a process. So that's just something they need to know. What if I receive future distributions from a trust? So distribution, we touched on this a little bit earlier, but distributions from a trust could be taxable in the hands of the beneficiary, depending on the decision taken by the trustees. Very important. So we need to look at that structure. The beneficiary must declare the distribution in their tax return. Therefore, if you are a beneficiary of a trust and are a non-resident taxpayer, do not deregister your tax number. It's very important because you're going to need it. And Mariska gave a bit more detail earlier on that. Okay, I'm handing over to you, Mariska, for the next couple.
Okay, so if you receive an inheritance in the future, tax migration has also become quite a big topic for this one, as Lauren has mentioned. Is that if you receive an inheritance, then we look at two things. It could be that someone was a minor when they left South Africa with their parents. So the question is always, were you ever registered for tax in South Africa? And if the answer is yes, then you need to do this whole tax migration process, cease tax residency, apply for a tax clearance, and only then you can externalize your inheritance from South Africa. But if you weren't registered for tax because you were a minor, then you don't need to register for tax. If the value is below 10 million Rand, they don't need any approval. They can just send that abroad. But if the value is above 10 million Rand, then we need to apply for a manual letter of compliance from SARS. But they still don't need to register a tax number. It's just a manual application that we do. Then this is a big question that we get a lot is, what if I return back to South Africa after 5 years or before 5 years? And the reason for this question is just because it used to be a big thing when financial immigration was still thing, and it was still the process to follow. And it was because it was a Reserve Bank process, is you could have been seen as a failed immigration and there were consequences, but it doesn't exist anymore. If you return after 2 years or 3 years, you just tell SARS, hi, I'm back. I want to be a resident taxpayer again, and then you basically just change that and come back. It's quite an easy process.
Mariska, how long does that process take if you reactivate your tax number?
So it would take 21 working days or up to 21 working days, and it's just a SARS appointment that we do and provide some documents.
Okay.
Must I sell all my assets when emigrating? And the answer is no. Like, lots of non-residents have assets and property in South Africa. You don't have to sell it. You can keep it here. The only thing to note now is that you're a non-resident taxpayer of South Africa, only subject to tax on your South African source-based income. So if you're keeping your properties here, you're going to be subject to tax on the rental income here in South Africa, or your investments like the interest and dividends. There are some relief when it comes to interest and dividends, but you can definitely keep your assets. Just keep in mind that obviously there's going to be tax consequences in South Africa.
Yeah, we get this question a lot. I think the assumption is always that if you have done financial migration or doing tax migration, that you had to sell everything, that you needed to close bank accounts, sell all your assets, and get everything out. And that's not the case. But it is, yeah, the tax on those rentals or the CGT does apply, which is important. Okay.
Okay, so this is quite a big one because we looked at the tax treaty or how to break tax residency. So the question is, what if you're in a country where there's no double tax agreement with South Africa? And when we looked at how to break tax residency, we saw obviously it's going to be the tax treaty, which is how do you become a tax resident of that country. And then the double tax agreement would allow either of those countries to have you a tax resident. But now you may be going to a country like Panama. We don't have a double tax agreement with them. So then it's very important to look at the ordinarily residence test and what is your intention. So we can motivate to SARS then that you are still allowed to break tax residency if we can prove to them that you've taken all steps to break ties with South Africa. So did you sell all your assets in South Africa? Did your whole family emigrate with you? What are your remaining ties in South Africa, if any? And then what are your intentions in the new country? Are you setting up a life there? Are you taking up employment? Just basically, are you moving your whole life to that country? So if you are planning to move to a country where we don't have double tax agreements, then it's just very important that you actually pack up and leave and take your whole life with you. And then in that way, you can still break tax residency in South Africa.
Okay, thanks, Mariska. Okay, do you want to just chat through those two in terms of the tests, just to give a bit more detail around the number of days around those tests?
Yes. So the ordinarily residence test we've discussed, it's basically just what's your intention. And then the physical presence test, this is how do you become a tax resident of South Africa again after you've ceased tax residency. So you would get someone who emigrate and it's their full intention never to come back, and they spend the majority of their time in the foreign country, but maybe they've got family left in South Africa, or we just all love South Africa so much that we want to come spend some more time here. Then it's very important to just keep track of your time spent in South Africa, because to meet the physical presence test, there's 3 requirements. The one is that you'll need to be in South Africa for 91 days, a minimum of 91 days in each year over 5 years. So let me start that over. We look at your previous 5 years. So let's say this year is year 6, then we will look at the previous 5 years. What was your presence in South Africa? So in each of those 5 years, you would have had to spend at least 91 days in South Africa, minimum. And then over a total of these 5 years, you would have had to spend 915 days here. So that could be in year 1, maybe you spent 91 days, year 2 was 100, year 2 was 200. And so it adds up that in the 5th year, you were here more than 915 days. If both those requirements are met, so minimum 91, a total of 915, then you would become a tax resident of South Africa again. So it's just always important to note then, like maybe in the 5th year, don't come for 90 days, come for 80 days, just to make sure that you're not meeting this test again.
3 requirements, and obviously they are still considered non-resident taxpayer. So
Correct.
that's okay, fantastic. Okay, I think we've covered just about everything. I'm sure there are going to be questions. So let me hand over to Robin and see if there's any questions for us.